I'm already on episode Iveracahar, episode number 4 of my options trading playlist, as I get used to the practical side of options trading before I actually go and start risking some of my own money. In today's video, we're going to start looking at LEAPS, specifically what they are, how we can trade them in Europe, and some of the key learning points that I have come across as part of my own research over the past number of weeks. You would always commonly hear American YouTubers specifically talking about LEAPS and how they use them as part of their investing, but you'd rarely hear anybody talk about them in Europe. LEAPS, which stands for Long-Term Equity Appreciation Securities, are not actually fundamentally different to options whatsoever. The only thing that differentiates LEAPS from any other options is that they have an expiration date that's at least greater than 1 year and could be anywhere up to 3 years from now. So do we have the facility to trade options with such long expirations in Europe? Well, I've checked out a couple of different brokers. I've started off using Interactive Brokers as a part of this video series, and as you can see here, if I look at some Google options on Interactive Brokers, I can buy call and put options with an expiration date of anywhere up to about 2.5 years. Definitely some other brokerages such as Freedom24 and Saxo Bank will have LEAPS as well that you can trade. Now that we know that we can actually trade them, let's have a look at some of the key characteristics and things you need to know about LEAPS before you start messing around with them. The first point to be aware of is that options with an expiry that are further out into the future are generally more expensive. And this makes a lot of sense when you think about it logically. If I had an option that was going to expire in the next week, I only have a couple of days for things to go my way and for that contract to become profitable. Whereas if, for example, the expiration is not until 2 years' time, then I have a lot of time for things to go my way. There is a higher probability for that contract to become profitable. If we look at this Palantir option, for example, which expires in 7 days, the at the money call price is around 0.56 at the moment. Whereas if I look at an option that expires in 2.5 years, the at the money call price there is $5.25. So in this case, it was nearly 10 times more expensive to buy a LEAP with the maximum expiration that I could get compared to the shortest dated option on the market. The second most important learning point for me was how much you should pay attention to volatility when you were actually choosing what LEAPS to invest in. Because let's look at what impact a change in volatility can have on your returns. So this option here, the underlying price of the stock is 20 and our strike price on our option is $17, and our option does not expire for 2.5 years, and the current level of volatility is 65%, and that gives us a call option premium of $9.67. Let's say the underlying strike price continues to rise and it goes to $23. Then our call option premium increases now to $12.10. But let's say now over the next 6 months, the share price stays at $23. We've lost 6 months, so our time to maturity reduced to 2 years, and then our volatility actually drops back to 30%. As you can see here, our call option premium then falls way back down to $8.43, even though the share price hasn't really changed. That's why it's very important to pay attention to the volatility so you don't get crushed by it. The third thing to be aware of is you may have to lock up your funds for a very long period of time to actually get a decent return on your investment. When you're trading with LEAPS, you need a lot of patience. The principles are quite similar to if you were just a long-term investor buying stock. Your position could end up being unprofitable for a couple of months or even over a year, or you might even end up losing a vast majority of the capital that you invested. Even though LEAPS are less risky than shorter dated options, they are still options at the end of the day. There is a chance you could lose 100% of your investment, whereas that is unlikely to happen if you are just investing in stocks unless that company just goes out of business altogether. But the good thing about LEAPS is they do give you leverage, so when you make positive returns, they can be sizable. The fourth important thing to be aware of is how much exposure you give yourself to LEAPS. The general consensus, what I can see from most investors that I see using LEAPS, is that you should have no more than 10 to 15% of your portfolio allocated towards LEAPS. Because let's say in a worst case scenario where you have 10% of your portfolio going towards LEAPS and something goes against you. Let's say a trade goes against you, then in the worst case scenario, you're probably only going to take a maybe 5, 6 or 7% hit to your overall portfolio, which is something that you can probably bear. Whereas you don't want to be in a situation where over half of your portfolio is allocated to LEAPS. You'd be just taking on crazy risk in that kind of situation. Point number 5 of the learnings that I took away were how to pick the correct strike price when you are choosing a leap. The common consensus seems to be that if you're, say, buying a call option, that you're better to go with an option that is deep in the money. So that's where your strike price is well below the current share price of the underlying stock. The reason for this is because these options will have a higher delta. And what I mean by delta is basically if you have an option with a delta of 0.5, if the underlying share price of the stock goes up by $1, then the price of your option should theoretically go up 50 cents. Let's look at that in practice here. So I have some Bank of America options up here. One at the money here has a delta of 58, and let's have a look at one more deep in the money. Let's go for a strike price of 23. Then we can see here that the delta increases to 80. The general advice that I have seen people give here is to go with an option with a delta of at least 0.75 or 75 or higher. Point number 6 I think we're on now is liquidity. Should you actually be worried about liquidity? If you buy one of these leaps that doesn't expire for like 2.5 years, are you going to have a bit of trouble actually trying to sell it if you want to sell it? With longer term options, there's definitely going to be a lot less liquidity. You may have to wait a little bit longer for your order to get filled, but generally from the advice that I can see online, if we just stay to some of the more popular companies, then we should not have any problems. But this is something that I'm going to have to test out in practice to see if it's reality or not. So now I'm going to try and put all of these learnings into practice and see how it turns out. I'm still going to use my simulated trading account or paper trading account on Interactive Brokers and just try out one or two different leap options and see how it goes. The first one I'm going to try out here is Bank of America. The stock hasn't been doing so well over the last year compared to other bank stocks. I haven't done too much research here because I'm using fake money, but I would be a little bit bullish on bank stocks over the next while, especially in this high interest rate environment. So I'm going to go with a leap on Bank of America. So I have picked here the longest one that I could go for. So the longest dated expiration at the moment is June 28th in 2025, which is 734 days from now. I'm going to go with a call option that is deep in the money at a strike price at $25. I'm going to select here. We can see as well the implied volatility on this option is quite low at the moment. It has a delta then of 74.9, which is close enough to the target of 75 and higher. It has a break-even price of $33.67. My max loss here is $867 if I'm just buying one contract. So I'm going to go with that. It's Saturday at the moment, so I'll have to wait until the market opens again. But I'm going to open a trade there on Monday morning and see how it goes. So I'll report back in the next couple of months on how that trade is doing. And I think that's pretty much it for me in today's video, lads. I hope you found it some way interesting. If you did, please make sure and drop a like on the video and subscribe to the channel and check out some of the other videos in this playlist. I'll be adding to it a good bit over the next couple of months, so hopefully we're going to get a good few videos done on options. Thank you, and I'll see you guys in the next video hopefully.